Hours veteran because I've been involved in the issue for over 20 years now. I kind of fell into the space working for a reinsurance company. I was a lawyer by practice, and I was an environmental lawyer, so I knew how not to solve any problems or environmental issues. But I got involved in what at that time Swiss Re was looking at, climate risk. And over the years, over the last 20 years, it's been amazing to see kind of the ebbs and flows on the issue of climate change. And it's great to see the ascendancy again of risk, in that people are starting to really grasp that this isn't something you just list as, oh, this is number 20 on our list of potential concerns. This is something that is potentially going to affect our bottom line, our viability, and potentially where and whom we can do business with. So I'm very excited to introduce my fellow speaker here. Her name is Tori Greaves. She's with the Climate Service, and she's got a great background. She had started her career in conservation efforts to protect vultures in Nepal with IUCN. And I was trying to think of the parallel between the vultures and the real estate industry, which is what she's here to speak about. So maybe we can kind of find some parallels. But now she's with the Climate Service and specializes on climate risk, and particularly the real estate industry. Tori. So Tori, what does the Climate Service do?
Yeah, well, first of all, thanks so much for having me, and great to see everyone here and virtually as well. So I serve as VP of Analytics at the Climate Service, which is a approximately 4-year-old climate risk analytics startup. We quantify climate-related financial risk, and we do so through our software as a service platform, which is called Climatenomics. So essentially, just to break that down a little bit, we start with climate hazards, and we ingest data primarily from global circulation models, which are developed by research institutes all around the world. And from that data, we calculate specific hazard metrics. So we actually quantify and measure how, for example, drought is projected to increase over time, or wildfire or coastal flooding in a particular area. Then the next main step, which is our kind of core differentiator, is that we then assess the vulnerability of any type of asset to each of the hazards that we model. And that looks really different depending on if you're assessing the vulnerability of, for example, an agricultural crop like wheat, or if you're talking about real estate, such as an office building or a multifamily property. So we characterize the vulnerability, and that's essentially a financial materiality mapping exercise, which allows us to get to the final step, which is quantifying that risk in financial terms. And for us, it's really important to make our outputs as decision relevant as possible for business leaders, risk managers, and investors.
Great. So I know the Climate Service just recently collaborated with Naveen on a very interesting report that focused on the climate impacts in the real estate industry. Could you tell us a little bit about the report and some of the findings?
Sure, and maybe just a bit of background. We've had the pleasure of working with Naveen for several years, actually, and the methodology that I just described is the way that we quantify what we sort of term direct impacts. So if you're considering the risk to a particular building, let's say even the Javits Center, we would consider the latitude, longitude, and elevation of this particular site, and also consider what type of property it is, because that's where we get to knowing what impacts we have to be concerned about, whether it's cooling costs or degradation of the HVAC equipment, or even something like if there's flooding that comes in from the Hudson, if we have to be concerned about interruption of access to this property. So that's where we started with this assessment for Nuveen and for many of our real estate customers. We ingest data about their portfolios. Worth mentioning that we do that for assets located all around the world, so we're ingesting lots and lots of data. And then we provide climate risk outputs that are specific to those individual properties. Once we had done that with Nuveen, they started asking some really interesting, challenging, probing questions like, okay, well, if this is the risk to this particular property, what about the broader area? Will people want to live here in the future? Is it going to be too hot? What about insurance? You know, we saw in 2018 in California, there were such frequent and devastating wildfires that insurers actually stopped providing insurance and dropped coverage. That could be devastating for the prospect of selling a real estate investment in the future. And then on the positive side, you take a city like Miami, where there's actually a lot of real estate investment happening from a certain perspective. It's a very active, hot real estate market. But as many people know, it's highly exposed to coastal flooding risk. What is the city actually doing to mitigate that risk? And is the risk as dire as just the hazard models propose in the vulnerability models? So there we start looking at municipal adaptation and the degree to which a city is investing in those measures to protect the broader area. So those probing questions were what led us to this market level work, where we wanted to say, how can we complement the direct building analysis, property analysis, with a broader understanding of what we term these market level impacts and factors.
I love this multi-dimensional approach, right? Because it's not just simply, oh, you're on a coast and therefore you should be concerned in sea level rise. You're thinking, multi-levels as to what the economic impacts potentially are, right? The potential factors of whether rents would be able to be available for renters would want to come to those properties and so on and so forth. I love that idea. I'm wondering if you could dig a little deeper into the idea in the report where you look at both the municipal levels and then the corporate investors and how that all interplays.
Yes, and it's not very straightforward. So this endeavor that we took on was a year-long first research project to understand if you really want to quantify these market level factors. And I should say that some other groups had done some foundational work on this issue, but what remained and what was lacking was a consistent framework through which to assess these market level factors. So how do you actually know if the city is going to be doing enough to protect a particular property? Is the seawall that they're investing in sufficient and going to be sufficient for a particular property? Will the city continue to have the political will and the economic strength in terms of municipal finance to continue funding those efforts? So we had to kind of take a step back and first really do our homework and establish a framework for systematically assessing these factors across different cities. Because also our theory of change at TCS and a theory that undergirds our entire approach is that you have to be able to compare different assets, different cities, different locations in as much of an apples to apples comparison as possible. Otherwise, it becomes extremely challenging to quantify risk and to also understand really where you hold the most significant risk. So we started diving into considering the actual particular levers that we would have to be considering for each of these topics. And maybe one example I can provide on insurability, just to dig deeper on that topic, because it's probably one of the most challenging concepts, I think, to consider in that apples to apples approach for a couple of reasons. First, I think we are now seeing the more intense and more frequent acute hazards. I'm thinking about wildfires, coastal flooding events, fluvial flooding, i.e. river and flooding events, that tend to trigger events of uninsurability, i.e. drops in coverage, or when premiums are projected to spike. But the insurance policies differ all around the world. Insurers, what they've historically insured versus what they might insure in the future is really an open question. And we do partner with some insurers and are starting to dig into some of these questions ourselves. But in our framework, what we brought it back to was, what do we know? And what we know from the climate model data that we source from the best minds on climate in the world is the projections of how different hazards are forecasted to change over time under different emission scenarios. So that's another big unknown. What what future path will we be on? That's where this scenario analysis is really critical. But we can start with those hazard graphs and see where are those projected really big spikes forecasted to occur. And we do see that particularly with flooding risk, where you'll have the annual probability of a 1 in 100-year flood. Historically, definitionally, that should occur 1% of the time annually. We do see spikes up to even that occurrence jumping up to a probability of 1, i.e. likely to happen every single year, which is not what we would want to see. And when we see those big spikes, that's where we can infer and develop some criteria around where we think there would be the most likely triggers of uninsurability events. Then it becomes an analysis of, well, what's been historically offered in this area? How many insurers have been active in this area? I just have a colleague of mine who recently purchased a property in Florida and was telling me there's actually only one insurer that he could choose from at this point in time.
And that's the state, right?
in this particular part of Florida. And that might lead us to think, okay, insurability might even be a greater risk in this particular area, because we've already seen instances in which we've had high spikes in hazard and insurers have responded by not offering coverage. So we really try to ground it in as much data as possible, and even ground the uncertainty in as much of the physical science as we can, because the socio-political response is really tricky to predict.
I remember that from my past lives, is that the state of Florida is the largest insurer in the state of Florida, which tells you something, right? That means a lot of the commercial insurance companies think many parts of Florida is just not insurable, right? And if it's not insurable, you can't get loans, right? You can't, so the state steps in. But now that the state's the largest insurer, what does that mean in the event of a catastrophe? And will the state be able to even pay all the claims? So huge. And I was struck by in the report some of the huge numbers. You identified $35 trillion in real estate at risk. And I saw another article recently where I think it's Environmental Defense is estimating between 4 and 13 million Americans will need to relocate due to climate risk to their properties. So, I mean, we're talking huge numbers here.
Yes, yeah, the 35 trillion, I believe, came from a UN report and was a 2070 estimate, so at some point in the future, but that was the best estimate of real estate investment that's at risk due to climate. And I think considering the human element is really important, even when we're sort of focused on real estate investments, which are very concrete and tangible assets, but the whole business model is very much tied to people wanting to continue to live and work in certain areas. And that's been an area of kind of increasing interest for us at TCS, is not only considering how humans might be impacted directly by hazards, such as we've seen, when there are increases in extreme temperature in some areas, there's an associated increase in morbidity or overall decline in human well-being in certain areas, particularly when we have heat wave events, as we did in the Pacific Northwest this past summer. That's a direct impact on humans, and there's only so much of that over time people will be willing to tolerate. That's on the chronic hazard side, where temperature extremes is something that's projected to change more incrementally than other hazards over time. But with something like a flood or tropical cyclone, that's also a consideration where people might be impacted, by Hurricane Harvey, and then be impacted by a hurricane the next year, and then just be unwilling to sustain that or endure that evacuation again in the future. And so I think it's really important for real estate investors to think sort of holistically about real estate assets as places for people, and consider the climate risk from that perspective as well.
So you and I had in prepping for this discussion, we had a very interesting conversation around some of the societal changes that climate change might bring, and particularly around social equity issues, et cetera. And I came across a term today. I was reading something and it was talking about blue lining, which I had not heard of that term before. I'm wondering if you could comment a little bit about some of the concerns about, do we see a flipping of value of real estate from coastal regions, for instance, to non-coastal regions? In essence, the rich can move, the poor can't. And I'm just wondering your thoughts on that.
Yes, we investigated this question as part of our research into rental market growth, which is really a real estate term for that element of how strong will the sense of community and people wanting to continue to live and work in a certain area be. And also from the employer's perspective, their willingness to continue to site their office facilities, their manufacturing facilities in an area, because that provides employment, of course, for people in the local area. There was an interesting study from the city of Miami that actually found documentation of what's been termed climate gentrification, where coastal areas, in recent years have been, in many cases, areas of higher value real estate. So larger homes, larger value, higher value resorts, those kinds of things. And due to recent sort of increases in coastal flooding risk, for example, we're seeing that those kind of higher value properties are now, and people are moving more to higher elevation areas that are protected from coastal floods. In turn, that then kind of pushes the lower income communities that were living in the higher elevation areas back down closer to the coast, exacerbating the vulnerability of those communities. So I think that, as was mentioned during the Women in Climate Tech panel yesterday, which was really focused on the gender lens of climate risk and, frankly, the absence of that lens in the whole TCFD climate risk conversation, I think more broadly, it's really worth asking the question of where is social equity being considered? Because many of these, the perhaps logical conclusion of an assessment of climate risk for a particular property could be divestment. But it's really critical to consider not only the negative impact that could have on the community by leaving an area, taking those jobs somewhere else, for example, but what actually has been giving me a lot of hope in this area was understanding the true contributing power that investors and organizations can have by remaining invested in areas that are exposed to climate hazards. As I mentioned earlier, one of the key factors in a city's ability to promote resilience at that municipal level is the strength of their municipal finance. Sure. How strong is their tax base, both corporate and residential? How strong is their credit rating, for example? And if there's an outmigration of jobs and people, those things go down. But if you remain invested, you could actually, investors and companies can play a very proactive role in promoting resilience in a particular community. And that has benefits, frankly, for that real estate investment itself, but also for the broader community and the strength of that community overall. So I think there's a potentially perhaps negligence that could be occurring in investment decision making around climate risk if social equity is not factored in. But I think the really encouraging thing is that there's actually a proactive, positive role that investors and companies can play too.
That's great. Let's just turn to the data side of it. What are some of the current limitations on the data to quantify climate risk that you're seeing and you would like to see, perhaps? Kind of maybe a wish list.
We have a crystal ball and we can predict the future. I wish. With climate risk, it's very interesting because we're trying to do our best to, as accurately as possible, quantify risk related to an uncertain future. And we've been hearing a lot over the last couple days of this conference about the transition to net zero and reducing greenhouse gas emissions, and the extent to which we as a global society actually achieve those emissions reductions is, of course, and uncertainty. I really hope we can get to that, below 1.5 degree future, but it will take a lot of concerted effort, and as every day passes is looking, unfortunately, a little less likely.
Are you seeing real estate investors looking at the scenario analysis, say that a TCFD would recommend, for instance?
They are, and that is something that our platform has been designed to empower as well. So we include different RCP emission scenarios. The higher ones are associated with greater radiative forcing by the end of century, which essentially translates to greater physical hazards frequency and intensity, generally speaking. And then there are different emission scenarios in which there's actually a sort of balancing that occurs where the physical hazards might be less extreme, but there's a way that we get to that lower emissions future, and that's typically through carbon pricing, and those factors tend to increase transition risks. So we have to, one of the most effective policies that we could put in place to reduce greenhouse gas emissions would be to put a price on carbon. And so we do model that risk as well. So with the lower emissions pathways, that is correlated with a higher carbon price.
So when people talk or do analysis on whether it's on companies or on real estate in relation to environmental, social, and governance issues and identifying risk, it seems to have always, or at least the ESG has evolved mostly to look at the risk side of things. Mm. How do you factor in opportunities, particularly around real estate, that might be coming up? Mm-hmm.
There are a few different levels and lenses through which to consider opportunities, and that is a core part of the TCFD framework. And I should say that our platform is completely aligned with that framework. It is the kind of leading guide that we have, and that the investment business community has been coalescing around in terms of not only understanding climate risk, but also disclosing that climate risk as well. So on the opportunity side, I think about opportunities in terms of what potential markets might become more attractive and more available for a real estate investor. There are different ways to consider that. Firstly, by considering different cities, and through this market level lens, again, viewing factoring that into investment strategy over time. Where might we want to invest in the future based on not only exposure to climate hazard, but also the degree to which the city is investing in protections, where people might want to live in the future, and also where we think the real estate market might continue to be strong going forward. So that's one kind of sense of opportunity. And the other would be, from a transition risk lens, opportunities in terms of lower emission buildings, different property types. And so I've seen some investors really factoring that in to their decision making as well, where I think it's been encouraging to see the extent to which low emissions buildings are becoming really in demand, and it's sort of projected that if your building is a high emissions property in the next couple of decades, it's essentially going to be just not that desirable.
So I was wondering if you had any concluding thoughts. So in essence, what makes you hopeful, and maybe what keeps you up at night in relation to climate risk?
Sure. Well, let's see. Maybe I'll start with what keeps me up at night, so we can end on a positive note. In terms of what keeps me up at night, I do think that as someone who looks at climate model data day in and day out, as we do at TCS, it frankly becomes pretty frustrating that we as a society are not yet doing that enough to reduce our greenhouse gas emissions, because I think it's more clear and perhaps more intuitive for investors and businesses to understand that if we have to change our business model or the way we do business to reduce our emissions, there's a cost associated with that. That's a bit more clear because you can sort of price out what is it going to take for us to change our business model in XYZ way, or change our operations in a certain way. That's more clear and a bit more tangible. What I think is not yet fully considered and understood is that there is a very strong price that we are already paying for not transitioning to a low carbon economy. And that comes in the form of this physical risk. in some places, investors are paying more for cooling expenses where temperature has already increased. That's not a line item that shows up as, hey, climate change, charging you this much. But
although I would argue, at least this year, you probably have people running to the door, right? Because you got the West on fire and the East underwater.
Yes, and that, I think that understanding is evolving and changing, but it has been harder to quantify the effects of inaction, I would say, than to price out and scope out the price of change. And yet, I think one message I would just want to emphasize is that we are definitely seeing the price of not transition to a low carbon economy, especially over even the next 10 to 20 years, which is the typical holding period for the average real estate investor. So given that fact, I think it's a bit frustrating that we haven't yet gotten to that point, but that's, our mission at TCS is really putting the dollars and cents on that, on climate risk so that we can help affect that change. What does make me hopeful is just the slew of regulatory shifts that we're seeing lately. We are now getting, we've seen a lot of interest in climate risk analysis from asset owners, asset managers in the recent year and companies. We're now getting a lot more traction among banks, and I think that is largely due to regulations coming out of, for example, the Bank of England, coming out of Japan and Australia, even President Biden's recent executive order on climate risk saying, hey, Treasury, SEC, we really need to be considering climate risk, and I need your recommendations on how we're going to manage this risk and what kind of disclosures we're going to require. And I think that change is extremely positive because climate risk is just frankly currently unpriced in our economy. Even in real estate transactions right now, very few investors are actually pricing in climate risk. And it's very hard to actually see climate risk where it is being factored into the data because, as you can imagine, if one investor is not pricing it in, they're willing to bid more on the property. That's where the sale happens. So those who are pricing in risk are a bit masked in that scenario. But we are seeing just a lot more traction, especially among the largest financial institutions in the world. And I think that is the kind of change that we need.
So should we anticipate some climate speculation in the sense, like a big short type idea where people will either flee certain areas or types of real estate for others, or?
I think that's a very interesting question. I do think it will be highly geographically specific if that kind of event were to occur, perhaps triggered by something like insurers backing out of a market, because that is where liquidity comes into play. Liquidity being, the ability to sell a particular property at the expected price and also within a certain time frame, and which is very important to real estate investors in the entire business model. And so if a potential buyer is concerned about their ability to source an insurance policy from a provider or the need to self-insure, that's going to really affect liquidity in that sense. So I think that could be more geographically isolated, but I'm hoping that by people attending conferences like this, having these kinds of discussions, hopefully putting our framework, our market view framework into practice, that we can get ahead of those events so that we won't see, catastrophic changes.
Thank you, Tori. I think we have time maybe for one question. Is anyone? Over here. Yeah. I don't know where the microphone is, but if you just speak loud, I guess.
Of all of the different factors considered in the market view reports, you mentioned liquidity and rental market growth and municipal adaptation. Which do you think is the most important one for investors to consider?
Great question. So the question was, of all the different factors that we considered in this market view report, being municipal adaptation, actually building adaptation, which we didn't have a chance to talk much about today, insurability, liquidity, and rental market growth, which is the most important to consider. And as is probably the case with many things in the world, these factors, while we describe them independently, are really intertwined. And so I would probably say that municipal adaptation has really comes to mind because I think that has downstream or subsequent effects on things like insurability and rental market growth. It really is a core piece of the puzzle. The picture of risk really might not look as dire because cities can be very proactive in terms of investing in municipal adaptation. Likewise, it could be a lot worse because they're not. And so I do think that it's the next point of climate risk quantification that all real estate investors should be doing is really considering those risks because frankly, those market level impacts might be significantly more material than any individual risk at a particular property. So.
Great.
Great question, thank you.
And I think we're right on time, so.
All right.
I bear of a bit of bad news is that we're going to be skipping the break, so hopefully no one needs to run out. And Tori, thank you so much.
Yeah.
Please give her a hand.
Thank you so much.